get going here, so I'd like to thank everybody for joining us today at the 2012 NAREIT Equity Residential Company presentation. With us today from EQR, we have CEO David Nethercutt to my left, Fred Twomey to his left, EVP of Property Management, David Santee, EVP of Property Operations, and then CFO Mark Stroh at the end. I'm Andrew McCullough. I'm a Managing Director with Green Street Advisors. We've been covering EQR since its IPO in 1993. Before we jump into Q&A, I'm going to let David say a few brief remarks.
Good, thank you, Andy. Good morning, everybody. Thanks for joining us today. As I guess you've heard me say, those of you who have bothered to pay attention over the last few years, it is a good time to be in the apartment business, and that remains true today. Across all of our markets, we're seeing the demand for housing that we expected going into our primary leasing season. Fred and David will be happy to go into whatever detail you all may like, but there's certainly no shortage of demand for quality rental housing across our markets. The demographic picture remains very strong. Jobs in our core markets remain pretty good. Supply remains down. Single-family home ownership continues to decrease. I'm not seeing any really noticeable trend in any change in reasons for move out across our portfolio to buy single-family homes. So just from a basic, pure, fundamental standpoint, the apartment business remains very strong, and see no reason why that won't continue for quite some time.
Great. Well, I think the first topic that we're going to jump into, and I think a lot of audience members would like to hear about, is about Archstone. So you recently ended a 9-month pursuit of Archstone, and that deal had the potential to turn into one of the largest M&A deals in your history and even the sector's history. And while the outcome was by no means bad for EQR, you walked away with $150 million, it probably wasn't the outcome you were hoping for. So I was hoping you could just talk a little bit about the process, what you learned along the way, what you think you did right, what you may have done different. Anything you share, we appreciate it.
Well, so as everyone may know, Archstone was a public company that went private in a heavily leveraged buyout back in 2007. And was owned at the time we became involved by two banks and the bankrupt Lehman estate. There was a kind of a general disagreement between the banks on one hand and Lehman on the other as to regarding the strategic direction of the company. And they were subject to a governance document that really didn't allow anything to happen without unanimous consent, and so there was a bit of a stalemate between the interested parties. We saw an opportunity to insert ourselves into that process and be a catalyst for some kind of change. As you noted, Andy, certainly our expectation, our desire was for that change to have been one in which we would have been able to acquire all or significant percentage of those assets. But in the final analysis, we had no ability to make anything happen, and it became quite clear to really everyone very early into the process. The banks wanted to be monetized for their interest. The estate wanted control, and we had created significant value for the position that we had structured. And several weeks ago, we had negotiated a kind of a compromise at the end of the day, which got the banks out at a number that satisfied them. Awarded control to the bankrupt Lehman estate, and gave us what we thought was reasonable value for the position that we had created. Certainly $150 million termination fee, breakup fee was certainly not a bad consolation prize, but it wasn't what we had hoped. What did we hope to happen? Obviously, we hoped to get more assets. We were disappointed about that. What could we have done differently? I think, frankly, we put ourselves in the position and played it out fairly well. I'm not quite sure there's anything that we would have done differently. I think we kind of played the position about as well as one could. What we learned in the process was how much the banks wanted out and how much the estate wanted control. So when we came to the realization that there was no way the estate would do anything except get control, we just set about trying to monetize the option value we created and get as much as we could out of that. But at the final analysis, now the Archstone's owned by this bankrupt entity that's in liquidation, and we have $150 million, and we're not precluded from talking with them if they want to talk with us in the future, and we remain ready and able to do that if they choose to.
Would you care to make a prediction what you think the future of Archstone looks like?
No, I mean, it's clearly there's been talk about some IPO execution, and remains to be seen whether or not that's feasible in this marketplace, in this climate today. But things can always change, but it'd be very difficult for anyone to predict what will happen today.
If you were advising Lehman how to proceed, what would you tell? Short of selling you assets on the cheap, how would you advise them to proceed?
Short of doing that, because of course that's the only logical thing they can do is sell us assets on the cheap. Look, I can't go there. They're advised by very capable people, and I'm sure that they'll execute whatever they think is the right course of action for an entity that's essentially that is in liquidation and within some reasonable time.
All right. I'll move on from that topic. Talk a little bit about apartment fundamentals. I think that the shrinking apartment demand has not disappointed investors, and you've had really exceptional rent growth probably going on for 2.5 years now. And I think as we all sit here today, the question is how long can that really good pricing power that you're experiencing continue? And I think some of your renters are probably getting third, potentially even fourth sizable rent increase, and rents that have been far outpacing inflation, far outpacing income growth. As you sit here today, I know it looks good, but just how long do you expect that to continue?
Yeah, I'd expect it to continue for the foreseeable future, just based on the fundamentals that we're seeing in the market today. That's all we really can react to is what the market is giving us today. And for the first quarter this year, we're at 94.9% occupancy, which was exactly equal to the first quarter of the year before. And we knew that this leasing season was going to be a critical indicator of how the rest of the year would go. And a few weeks ago, all the indications of demand leading into our peak leasing season, kind of lit up on our dashboards. Internet traffic was way up. Walk-in traffic was way up. Telephone traffic was way up. Our call center phones were ringing like crazy, and that was a great indication. And what happened was we recovered that occupancy from the seasonal slow first quarter to now. We're 95.6%. This morning. So we had a tremendous demand in the system. That was very reassuring to me that the demand is there. And we expect things to come in leasing season, but we really got everything we expected, maybe a touch more. Our occupancy today is about 20 basis points higher than the same week a year ago. And our exposure, or left to lease, this morning is 7.2, which is 20-30 basis points better than the same week a year ago. So the indication is that the demand is there. Demand for urban, high-density, high-priced apartments is definitely there. Our target demographic, college-educated young professionals who want to live in the great cities in this country in an urban environment, are there. The incomes of those people coming in are getting better and better. They're very healthy. They're high. The income-to-rent ratio is very low. It continues to be healthy and give us some run room. And the people coming in leasing new apartments, there's very little, if any, price resistance. Now, we did see in the first quarter some price resistance on our existing residents who are getting those second and third big increases, because during 2008, 2009, parts of 2010, when rents were going down, a lot of people got really good deals on the apartments. They were living great apartments at a good value, and now we're catching up to kind of the price point. So we're getting some resistance there, as we reported in the first quarter, especially in markets like Boston, New York, and San Francisco, the leaders in the recovery of rents. So yes, we would expect that, and our turnover is up as expected. We'd be kind of disappointed if we didn't have that, because we're refilling the apartments quickly at great rents. So the summary point, what we see right now is that we like where we see, we're sitting today in the early stages of the leasing season, exactly where we would expect to be. We're very satisfied with that, and the health of our resident base seems to be in great shape, and no real concern about demand coming into the season.
You touched on a few markets there. Maybe you can expand. Can you just talk about which markets you're most optimistic about right now, and maybe which markets concern you a little bit? Okay. Yes, all markets are doing better. And what I said, the leasing season is starting off great. That's really across all markets. On a relative basis, some better than others. On the positive side, continue to love the Northeast. Boston is having a great run ahead for the last couple of years. A little slow during the January, February. We said we had some turnover, but now it's come back very quickly, very strong, and the rent growth there is still healthy. So Boston, especially the downtown, close in, the Cambridge markets, are very strong. Further out, maybe not so much. New York is still very strong.
New York, the demand is there. We're getting it. The financial sector is stable, and then we're getting continued growth and a lot of excitement from kind of new entrants into our mix here, and that is technology workers and new media, entertainment, music, fashion, consultants, lawyers. We're not relying so much on the financial sector anymore to pay these big rents. So there's a lot of demand, really a shortage of housing in these great neighborhoods. So New York's still very strong. San Francisco, same thing. The tech business there is very strong. A lot of hiring on the hardware side, the software side, the telecommunications, mobile technology, even the biotech, clean energy. All those sectors are hiring, and we had a very strong rebound after seasonally softness, which we typically have there in January and February.